let's bring in our guest. We have Robert Schein, who is Chief Investment Officer of Blanke Schein Wealth Management. Robert, thank you so much for joining us today. Give us your take on the CPI number and what it means for monetary policy going forward.
Well, it was a welcome number. It was certainly a relief. Wall Street's been anticipating this for several weeks now, and this actually adds into the Fed's playbook for a soft landing. But our take is that the Federal Reserve is going to have to go one more time at the end of this month for a hike, and then go higher for longer in terms of just a pause. But there's always the chance for the Federal Reserve to ultimately hold it too long in terms of just keeping rates where they are until they have to do an emergency landing. And that's ultimately potentially what could be playing out in the back half of this year, maybe in the 2024.
What do you mean by an emergency landing? What does that look like, and what would that do to the market?
Well, if you go back, the Fed was way behind the curve when they said inflation is transitory. Now, if you look, you have to get through 2023, 2024. A lot of their work, a lot of their tightening is actually taking hold, specifically to the consumer. And we're seeing this play out all across the board. Now, later on, later this year, early 2024, it's going to be, we're going to get a print in some sort of economic number where the Federal Reserve is then going to have to continue or position their pause to a emergency landing where they're going to have to start adding some more stimulus or accommodate at some point in time. Because I think right now we're done after the July meeting of raising rates. And I think the consumer, all of the cumulative effect, essentially is what I'm saying is going to catch up to the consumer in the U.S. And that's going to hold down the consumer, and it's going to eke into all of this economic data.
So in that respect, what do you think is going to be the trigger in that respect? Do you think, because you mentioned a consumer breakdown, but how do you think it's going to be reflected? Do you think we're going to see, a disastrous NFP? Do you think it's going to be more of a function of, just in terms of the consumption data being horrendous? Or is it, the bow breaking when it comes to, say, for example, the banks and just a credit event? Because I would imagine that they'd need to see something, given what they've been doing of late, something tangible that they can point to and say, okay, this is why we're going to be changing our policies so severely and fast.
I think the Fed's going to have to pivot from looking to the left, which is waiting for the wage, the JOLTS report, the jobs opening, to ultimately, what we're seeing in the employment picture, which is lagging indicator, to what's going to happen with look through the windshield, which is consumers. The debt's piling up. If you look at consumer debt, it's the highest that we've seen since 1981. In terms of 21% on credit cards. So this has a cumulative effect, and it has a tightening effect. Ultimately what the Fed wants to do, but they're going to have to then at some point in time, I think a lot of consumer data is going to fall off at some point in time, and the Fed's going to wake up and say, oh, wait a minute, we're going to have to now shift to accommodative because the consumer can't handle the stress anymore.
It's been falling off for everyone in the top 20%, I've got to say that. But I've got to ask you, because obviously, it's Amazon Prime Day. You hold Amazon. Everyone's talking about Amazon right now. But apart from, potentially the little benefit they're going to get from Rivian's share price absolutely surging, offsetting what we saw last year. But on the consumer front, even with the Prime Day sales, are you thinking of Amazon a little bit differently because of the thesis that you just suggested, that they could be seeing weakness maybe at the end of this year, the start of next year?
Amazon's already been through the recession, 2 years ago, if you look at the stock price from a technical perspective, and year to date, they're rebounding. We love Amazon. We hold Amazon for our clients. So we're long-term holders and believers in Amazon, also with the AI component built in. Amazon will be, they're light years ahead of everyone else. In fact, if you actually ordered something today, there's a good chance that you actually received it today. I don't know if you've experienced that, but they're really working hard from, 2 days is 2 years in the past. 1 day or same day delivery is absolutely amazing. But what's also interesting when you speak of the consumer, as I did earlier, Apple has been actually contributing to Amazon in terms of discounting today for the first time ever. So Apple products you can get on Amazon Prime. So that might speak into sort of picture preview of what Silicon Valley sees, or what the big tech sees, as to what they have to do to adjust to the consumer. We saw this with Tesla. lowering prices. We saw this with Apple now on Prime Day. It's good that they can, potentially pivot quickly, but it just shows that the consumer is feeling the stress. Ultimately, is what I'm saying.
Mm-hmm. And indeed, I believe that you've been taking profit on big tech, Robert, and you've been reinvesting that into energy and financials.
Yeah, so again, we love big tech. We're always a believer in big tech. We're going to hold it. But also, when Amazon and Apple and NVIDIA, have the years that they've had, we trim and they rebalance. And you have to look at the value that's out there in the marketplace right now. The dividend players, we like Chevron. Energy's down. Chevron's down 10% year to date. It's yielding, 3.8% on a dividend yield. We believe that energy now is going to transition to sort of getting wind in their sail for the second half of this year. So I think energy at $70 per barrel is a good, sort of bottom spot right there. And also some of the financials, you're going to see some opportunities like T. Rowe Price in there. They've also a quality dividend player. They've raised their dividend in terms of dividend growth for 38 consecutive years. So you want to go to stability here. You want to sort of rotate your portfolio, rebalance, diversify, take advantage of what the market's giving you, and then sort of, it's okay to sell into the strength of the market and rebalance into terms of what's underperforming or what no one else really cares for right now. And that's the key, share accumulation of what's down.
I've got to ask, because obviously we'll get into some stock picks. We've got you for two segments here. We'll get to that after the break. But just, relating to what you're suggesting and, you've got to deploy carefully, isn't it, or could not be made the case that right now, considering that the clip that you're getting on some of the short-term yields, maybe, 5.5 is better than the broad EPS yield that you're getting out of the S&P, that perhaps investors should just park for 6 months and just ride out any kind of potential volatility that we could be seeing throughout the end of the year?
Yeah, so the fixed income market is moving fast and quick. And if you watched over this last week, that's exactly what's happened. Yields have fallen. And today, yields have fallen again. And so, we've locked in yields. Year to date, we've loved the Treasury market. And now is the time to look at extending duration in sort of the fixed income capital, the spectrum. And there's a lot of opportunity there, opportunity in munis, opportunity in corporates. But there's also opportunity to lengthen sort of out on the yield curve because rates will start falling. And that's sort of counterintuitive of what everyone sort of is positioning on right now relative to their portfolios. So we're, extending duration on our fixed income. We love treasuries. I've been out here before, even a year ago, talking about treasuries and our treasury allocation on the short term. Now I'm talking about extending that out because yields will start falling in anticipation of the Fed having to sort of pause, hike, pause, and then pivot.
So you lock in some of that yield for the long term. Robert, stay right there. We're going to talk a lot about your stock picks coming up right after this. Street Signs is back in 2 minutes. You're back on the street and we're back with Robert Schein of Blanke Schein Wealth Management. Now, before the break, we promised that we're going to talk some stock picks. So let's get right into it. Firstly, I wanted to speak to you about a thematic that we talked a little bit about before, and that is obviously energy and the way you're choosing to express it via Chevron. Why Chevron specifically, though? Because, I suppose the easiest trade right now, if you're thinking about investing in energy, is just buy into Occidental. You've got your floor. You've got Warren Buffett taking care of that. Plus, you get the potential upside of all the integration that he's doing in terms of, the Cove LNG buy that he just did and shipping that LNG over into Japan. So there seems to be something afoot when it comes to Warren Buffett's strategic intent.
Well, yeah, again, we love Chevron, and we'll talk about that in a minute, but we also love Berkshire Hathaway as well as Occidental Petroleum. We own them as well for clients. But getting back to Chevron specifically, again, it's a 3.8% dividend yield. It's down 10% for the year. Energy has been out of favor. We believe energy right now is ultimately sort of bottoming right now for crude oil. And so we believe seasonally as well as, around the world globally, there are some sort of stability in place to support crude oil moving forward. But specifically going back to Chevron, the last 24 months, they've done a lot of cost-cutting measures internally. And so that's going to sort of, work their way through, as well as sort of operational efficiencies. So yeah, Chevron's, if we get wind in our sail with, oil prices going up, operational efficiencies, great dividend yield, it's going to be one of the portfolio that's already down, get paid while you wait.
I've got to ask you though, because if this is a play on, the oil price increasing and a play on dividend yields, do you venture outside of the United States? Because a lot of people like Petrobras right now for that exact reason, but the yield you're getting is far higher than any of the US oil majors.
Yeah, it's true. But also, Chevron's also a multinational as well. And so even if we look at the dividend yield, if we look at the dollar sort of falling down and coming back, that's also going to help, Chevron's earnings as well. But yeah, no, there's a lot of opportunity in the energy space. Listen, if you don't want to pick one, just go to, XLE. In terms of adding energy to your portfolio, ultimately it's only 4% of the S&P 500 in terms of contribution right now. Well, you're getting technology, which is close to 30%. So that imbalance has to sort of, we believe, at some point in time, sort of, come closer together. So that's why we're trimming we're adding energy, but we're trimming sort of the large cap growth, if you will. And it's always good to buy something that's undervalued at this moment in time.
Robert, it's a sad fact of life that we live in a dangerous world, and defense spending certainly seems in the US to be an area of bipartisan support. I see you like Raytheon here, which I'm imagining whether there is a recession or no recession, defense spending is still going to get its share of the pie.
Again, as we look at the world, as we manage our clients' assets in terms of investment portfolios, you have to be defensive. And also, you have to add defense in the defensiveness of your portfolio, if you will. And that's what we were doing with Raytheon. It's down year to date, defense is down year to date. But let's say 12 months down the road, we have heightened geopolitical tensions continuing. I don't see them abating. Maybe you do. But also, you have the consumer feeling the stress and the pressure, here locally of what the Federal Reserve has done. So we have to sort of insulate our portfolios of what we add to our portfolio from a recession. If you look at Raytheon specifically, all they have to do is execute their order book. They have many years to come of just pure execution right now, based upon the orders that are piling up for them. So, it's a good sort of undervalued play relative to the price to book value of the company right now. And you're also going to get, a little bit of dividend. That's why it's sort of our dividend theme here today for you guys. But ultimately, you get paid by weight and then add defense to your portfolio.
As we're about to start the Q2 earnings season in the US, which would be quite the catalyst for the markets from here, look, it's not pulling a rabbit out of the hat to be able to beat on earnings these days. It's nothing that a bit of creative accounting and management of expectations can't handle. But what you really does tell the true story is what's going on with your margins. What do you think we're going to see this earnings season? And do you have a playbook in terms of what people might want to buy or sell?
Yeah, this earnings season is going to basically tell us everything we need to know in terms of the inflationary impact for wages. That's what the Fed has been talking about. It's what companies and corporations have been talking about. But ultimately, even the first quarter, if you go back to first quarter, Q1, they basically managed expectations extremely well. They beat on the top and bottom line across the board, and it was exceptional. And that's what sort of propelled us to where we are today. That's what we're going to be waiting for. This Friday we have kickoff of earnings season for the Q2 reporting, and we're going to be listening intently as to where the bottom line ultimately, because year over year sort of top line you can get that from sort of where inflation has been, but the bottom line, managing costs, managing wages, all of the input. How corporations are doing it. We believe that companies will still exceed expectations once again. So this will be a nice quarter for the S&P 500.
Good to talk to you. Thank you so much for joining us today. Robert Schein of Blanke Schein Wealth Management. It's been a great conversation. Plenty more market action with our big bevy of reporters all